Okay, good afternoon, everyone. Thank you for taking time out of your busy day to join us for today's webinar about 2021 business lending, why wait and see is not a strategy. For today's webinar, we will take questions at the end. So if you do have a question, please submit it and we will answer those at the end of the call as best we can. Later this week, we will also provide everyone with a copy of today's presentation and a link to the recording so you would have that as well. My name is Sean O'Brien. I'm the president of QuickRate, and I am pleased to be joined on the webinar today by Arne Monson and David Ruffin. As most of you know, Arne is the president of Holtmeyer Monson. Arne and I have been friends for over 15 years, and I'm thrilled to be a part of a webinar with him today. He is the expert for SBA and USDA lending for community bankers. So when it does come to SBA lending, we have the experts, so we're all going to learn something new today that will help us in our banks. In addition, David Ruffin with IntelliCredit, a new division we have here at QuickRate, will provide you with insights on how to best navigate the credit tail that might begin to show in 2021. While I've not known David as long as Arne, I feel equally fortunate and honored to have him join us at QuickRate, as he is a leading authority on credit risk management for community banks. So at this point, welcome to the webinar. I hope you enjoy it, and I will turn the presentation over to David.
Great. Thank you very much, Sean. Obviously, the predominant issue we've all dealt with in 2021 relative to lending and credit has been COVID related. We knew that there was an inevitable change in the credit cycle that would occur after several benign years of quality growth. But we didn't realize, or in our wildest dreams, think it would be something like COVID that would have the effect it's had. Certainly, uncertainty is the name of the world I think we live in terms of credit quality. Uncertainty relative to the short and long-term effects of the economic shock that Sean just alluded to. Frankly, over the impact on your loan portfolios in terms of quality and growth. Over the disparate impact on the industries. I think that's one of the differentiators of the COVID environment from a decade ago's crisis. COVID has left with a number of disparate impacts of a number of industries rather than just a 1 to 4 family housing, for example, that predominated the Great Recession of a decade or so ago. The impact on bank valuations, if you talk to investment bankers today, they say in some cases more than any time in their career have they seen such uncertainty in the ultimate impact on credit quality, which has had an effect on bank valuations, as you know, in the last year at the regional and community bank level. So the uncertainty, as the Fed famously said in July FOMC minutes, that unfortunately the fate of the economy will follow the fate of the virus. We certainly have great expectations around some of the speed and effectiveness, efficacies of the vaccines and the therapeutics that are being talked about in the last few weeks. But we also know that we still are looking at probably some weeks and perhaps months ahead of some difficult circumstances. The good news in all of this for us in the banking world is we have more capital, more liquidity, more risk management, and certainly no blame in this case to go around relative to what happened a decade or so ago with the housing crisis. In that vein, I think we are also on a bit of an upturn in terms of public perception of the lending world, in terms of what community banking particularly has done with PPP lending. And I think a lot of what we're going to talk about today hopefully would be an investment in continuation of that goodwill in embracing government guaranteed lending. So why should we be vigilant in 2000? The two words, uncertainty and vigilance, to me are the operative words of the day. Our current credit metrics, I think, frankly, are somewhat misleading. They're misleading because I believe we're all the beneficiary of a bit of a COVID high, masking credit deterioration that may be embedded in all of our portfolios. That obviously has come from the massive degree of federal stimulus that hit the streets far quicker than any of the stimulus did a decade or so ago. And there's still uncertainty as where the next step of that is, but I think Arne will have some very more substantive news on potentially some more PPP developments later in the presentation. We obviously had some regulatory relief in very explicit terms, such as allowing for extensions and modifications, the suspension of the TDR, troubled debt restructuring, coding, identification, but that's not going to last but so much longer. And I think we clearly have been the beneficiaries of a flush of non-baseline or non-organic loan growth that is somewhat misleading, and certainly the liquidity that has come with a lot of the federal stimulus in terms of deposits. But I do believe one of the differentiators that we have to live with is that our credit, people on this call, the credit you're dealing with day to day lives, so to speak, on Main Street, not Wall Street. We've had a massive snapback on Wall Street in terms of recovering from the depths of the spring and the impact in the stock market, but we're in a recession. And we have to realize that upwards of 50% of Americans are not directly invested in the stock market. And in many ways, they are looking at survival, not investment mode for the future. And they are in many ways the bulk of the consumer and small business borrowers in the world that we live in. And we know from as credit risk managers that in and of itself is a classic red flag in traditional credit risk 101. What should we do going forward in 2021? I've come up with what I think are 8 action plans that we should consider in the financial industry into 2021. One is knowing our concentrations. I'll elaborate on each one of these just in a brief way. Secondly is recognizing the varying COVID impacts on our borrowing industries. Thirdly, identifying our stressed borrowers, adjusting our credit management focuses that would be more appropriate to the COVID environment and the post-COVID environment, and enhancing our loan review coverages and effectiveness. Knowing our vulnerabilities. And certainly, we've said this many, many times over this past years, given the fact that the regulatory respite will indeed, I think, be over in 2021, each bank must and financial institution must simply embrace the concept that you better be writing your own credit risk profile script before a regulator does it for you. And then, most importantly for, I think, this conversation today is to find alternative sources for loan growth. So let's talk a little bit about what we're speaking of here. Know our concentrations. Many of us often think of real estate concentrations, but again, we're talking about business lending today largely. But we're having to deal with, irrespective of the guidance on real estate concentrations, that all forms of concentrations may be something to be tracking at our individual banks. CRE in its broadest terms, for instance, it's basically the Northeast and the Western states that have the largest concentrations of CRE, likewise with multifamily. The next chart is C&I, and that probably depicts everything we now know about what I call the funny money of non-organic loan growth that's going on in the banking industry, the huge spike ups as of the second quarter in C&I lending. Again, some of that is not going to be permanent loans. And then, of course, in ag lending, you've got, not unsurprisingly, most of the Midwest banks have a little bit more of that concentration that they have to be monitoring. As a credit risk manager, I've always believed concentrations can kill, kind of like speed, if you don't manage them properly. The FDIC did an excellent, published an excellent article at their behest that they sponsored in July of 2020, where they did a study of all the failed banks during the last financial crisis. And the key findings were that 70% of those banks had significant CRE concentrations. Another issue of behooving us to be more dispersing or divesting or diversifying our portfolios into business lending that Arne will speak about in a moment. They also indicate high concentrations of late cycle growth, or what we call vintages, which is a lack of loan seasoning significantly exacerbated the losses. So in other words, loans made late in a good, healthy credit cycle always prove often to be the most toxic. There was a high correlation of collateral dependence, which unfortunately, when you most need collateral in lending, it's often further depressed by the market commodity valuations, which is really the worst of both worlds. And of course, it had a lot of state and regional market forces as critical covariants. Another reason, again, to talk in terms of business diversity in our portfolios is, as of 2019, CRE lending in all of commercial banking had, for the first time in our modern era, now equaled 1 to 4 family residential lending in commercial bank portfolios. And if you take just the community and smaller regional banks out of these numbers, that number would be even greater. As you know, smaller banks have stopped as much consumer purpose lending over the years. But knowing our concentrations involves understanding where they go. And I'm using predictions coming from our tools at IntelliCredit today to show you what I think is critically important to be able to show portfolio analytics, particularly in 2021. Understanding your concentrations about loan types, irrespective of just real estate guidance coming from the regulators. Understanding how your concentrations affect your capital, asset-based capital exposure or community bank leverage ratio, whichever approach you're using. We have a customer in Nebraska, for example, 650% of their risk-based capital tied up in ag loans. Not unsurprisingly, but he has the ability, the CEO has the ability to quickly tell his story of how clean that portfolio is, and frankly disabuse a regulator from having negative connotations or concerns about his ag concentrations. Recognizing, as I alluded to a moment ago, that COVID has left us with a disparate number of industries that have negative impact. Certainly, NASIC codes is more popular now than ever before, as it should be. Hopefully, you're using those to identify industry-specific credit issues within your portfolios. Certainly, hospitality and restaurants come to mind, and that certainly is important that we do things like that. We also are needing to look at our portfolio as really the sum of the many, many parts. I think that's the other COVID lesson we learn now, is that we're going to have to treat our whole portfolio as a multitude of subsets. That also includes the ability, as we've shown here in our product, the ability to differentiate your COVID-affected loans or your PPP loans or your SBA loans or asset-based lending loans, whatever other type of segregated types of loans you have. I think it's very, very important to begin to understand risk profiles that emerge out of each one of those different types of loans. A classic example is, of course, the ability to look at risk grade migrations. On the left, you see a bell curve around general risk in the portfolio in the past loans. Doesn't tell us much from period to period, but if you look over to residential construction, it gives us some more concern that maybe risk is deteriorating. Identify your stress bars. We're moving into a phase now where the tedium of having to understand the importance of your portfolios relative to individual loans that are borrowers that are going to make it or not. This is a tool that we use to give you that ability to avoid just being bottlenecked at a spreadsheet, giving users the ability to manage those problem loans. We need to adjust our credit management focuses, COVID and post-COVID, into, again, pivoting to the individual loans that may or may not make it. I think talent assessment is in order. The need for workout specialists and problem asset management people has not been an issue whatsoever in the last several years, but indeed may recur as a need. Policy adjustments. We all know sometimes we get trapped in the banking industry over policies stating one thing and regulators saying, well, your performance doesn't seem to adhere to how your policies dictate. This is the time to adjust some of your policies to a more practical, rational aspect of how you're dealing with today's environment. I think this will be marked by conservatism without overreaction in some ways. Stress testing, while many of you on this call are not federally mandated to do stress testing, we're hearing more and more anecdotal comments from our clients that regulators are strongly suggesting portfolio and loan level stress testing be done in the near term, particularly in 2021 relative to your portfolio's risks. I do believe, because of the preponderance of capital, as we talked about earlier, we'll be having more of a focus on reserves going forward as opposed to charge-offs, which really predominated the last credit or financial crisis that we dealt with. And that's going to muddy the works a little bit because of the issue of how I know investment bankers think in terms of focusing much on net charge-offs. But also, needless to say, as the whole program today talks about embracing government guaranteed loan programs. Also, I think avoid that trap that we get into sometimes in the banking industry of assuming that all loans are good loans until they're bad loans. That's a little bit trite comment, but reality, what that does speak is to the structural bias we have in the banking industry that, remember, we're driven often by call report standards, which basically talk about publicly disclosed, criticized, classified, but the real art of credit risk management is in those risk migrations within the past loans. You should be able to use and look for tools that are practical and affordable that give you the ability to do this type of subsetting, this type of portfolio analytical aspect to understanding what parts of your portfolio may be hotspots and those that are not. And I do, as we said, focus on risk grade migrations. Also make loan review more effective and efficient and dynamic, which leads us to number 5. There's been a bottleneck at some level of some activity in loan review. I think it's very, very important that you enhance and get caught up on loan review and make it far more effective. Remember, the guidance on loan review was issued in May. Even pre-COVID, regulators were concerned about the quality of loan review going forward, and that's going to be a huge focus, I think, as we look into 2021. We at IntelliCredit have made a real key point of trying to bring loan review out of a more detached way of looking at loans and integrating it with diagnostic management as well. And also, I think asking who is doing your loan review. Are they qualified? That's going to be quite important now relative to benign times when you could look to a less skilled person or experienced person to do loan review. Understand, again, has the backlog of loan review created a situation that may exacerbate, frankly, loan losses later? Knowing our vulnerabilities in the banking industry, I think, is very, very important because we have to accept that there's structural biases, largely because of capital, largely because we know our problem borrowers, unlike the big banks in many cases. And thirdly, we are so tied to real estate lending. And even as we look at a very benign environment today, we are seeing that many of the smaller banks are carrying more inventory of problem loans, which means that the tolerance or the capacity for more credit problems going forward may be somewhat problematic. So 7, again, is write your own script before the regulator does it for you. That is absolutely the theme, in my opinion, of effective credit risk management going forward in 2021. And then finally, number 8 is finding alternative sources for this lack of organic loan growth. I had the honor of writing an article that was just published, I believe, this week, Arne, for your newsletter, Holtmeyer and Monson. And in that, I did talk about the ability for banks, while they're having to deal with the shrinking pool of classical qualified commercial business lenders, to look to government guaranteed loan programs. 3 things primarily: greater organic loan growth. You have that also the ability to look at the patronage of the other underwriter to give you that kind of value add or hedge against credit risk. certainly gives you continued goodwill in the marketplace along with PPP lending is that you're also a robust government guarantee, the SBA or USDA lending, and then obviously the profitability of the fees that come from that in the secondary market sales. So having said that, I have the great honor to hand this over to Arne Monson, and I believe, Arne, you would like me just to be on notice to change slides as you so indicate.
Yes, absolutely. Well, first of all, thank you, David, and also thank you, Sean, my dear friend, for the kind words. Give you a brief overview. As I was looking at the roster of today's attendees, I see a lot of friendly names in there. So those of you that are H&M clients, thank you for taking the time. The others, this will be an introduction, but we're pretty well known nationally, so you may have heard our name, and we can talk a little more specifics later in the presentation. Holtmeyer Monson is the largest lender service provider in the country. So we work with community banks just like yours, and we become your fully staffed, outsourced SBA department. So in a nutshell, we are the outsourced alternative to staffing up an in-house government guaranteed lending function. Pause, and then I always have to say, without the overhead. As you know, in your community banks, people are expensive, and to the extent that you can control those expenses and still provide a high level of service, that's our role. That's why we exist. So to kind of drill down into the presentation here, we've been talking about risk and mitigating risk, and how do you analyze that, first of all, and what are some tools that we, Holtmeyer Monson, in a collaboration with IntelliCredit, and we're happy to have that collaboration, by the way, how can we add value to your enterprises? That's really the message here. So presently, we're all negotiating our way through the pandemic. This is uncharted times, and your borrowers are, charting their way through it as well. So, as David mentioned, you probably have some deterioration in your credit quality that you may kind of be aware of, but it hasn't hit the fan yet, as they say. So to the extent you can be proactive, that's the urgency that we're trying to talk about today, that don't wait. Try to get ahead of the curve on these commercial credits. So extra stress on small businesses and their ability to refinance, to provide financial operations. Access to capital is more critical than ever. These stressed borrowers need access to capital to keep their businesses alive. So the slide we're looking at now, mitigating risk. As I mentioned, we're all in the risk business. To the extent we can mitigate that, first of all, identify it, and then mitigate it, that keeps our institutions healthy. A great way to mitigate that risk is, through a government guarantee. SBA, Small Business Administration, and the USDA, the Department of Agriculture, offer a myriad of loan programs, direct, not so much direct loan programs. The 504 program is a direct program, but guarantee programs that will provide that credit enhancement that is so needed at the bank level. Both agencies are very well funded. Funding is available, plentiful. Congress has come to the realization that these agencies are the lifeblood of small businesses throughout the country. So they've been very well supported in Washington. Next slide, David. So why are community banks making these loans and get ahead of the curve here? Well, as I mentioned, both agencies have adequate funding, very adequate funding available. Lenders have limited experience with SBA lending. Presently we're serving over 400 community banks nationwide. We had a group of banks that got involved with the PPP program that had never made an SBA loan in the history of the bank. And they were kind of forced into the PPP program, but as they got involved in it and they worked with us, they decided, this is worthwhile to continue in some manner. after the PPP phenomenon passes. So they, and your institutions may be in that class. SBA and USDA activity, it is specialty lending. It is something very close to C&I lending, but typically an SBA or USDA borrower has some inherent weakness that you first of all have to identify and then overcome or mitigate that through that government guarantee, which, by the way, is exempt from loan limits at the bank level as well as reserve requirements. So we do business with lots of small banks across the country that have very limited lending capacity, and they look to government guaranteed lending because you mitigate the risk and you avoid the reserve requirements and the lending limit issues there. So one way to get into this business is affiliating with a quality lender service provider. Sean, as we were putting this together, and David and I said we get about 1 minute of shameless promotion. So I'm using up part of my minute here. We would be delighted to introduce our services to you, and you can certainly look on our website. But again, if you don't have the ability to staff up internally and you want to be in the government guaranteed lending business, the outsourced alternative is a real good option for you. You don't have those sunk costs. And again, people are expensive, and overhead, can really take a bite out of your bottom line profit. So, and there is a very lucrative, very active secondary market to sell these government guarantees into at significant profits. We sold 2 loans in the last hour at 12.5 points of premium. So investors are paying 12 points of premium above par to buy those SBA or USDA guarantees. And that those premiums, by the way, are taking into bank earnings at settlement. You don't have to amortize it over the life of the loan, and then you generate some trailing servicing income. So good programs, and we encourage their use. Next slide. Here's just a highlight of some of the more popular programs that are available. The most widely used, the most well-known SBA program is the 7A program. That's the guaranteed loan program. Commercial bank makes a credit facility extension to a qualified borrower, and upon that, they get a percentage, full faith and credit government guarantee. The maximum gross loan under this program is $5 million. Those guarantees up to $150,000 are 85%. Above that, up to $5 million, is 75% full faith and credit guarantee. One of the beauties of both of these programs is you can extend the maturity because of that SBA or USDA guarantee. And what that does is takes pressure off cash flow. So that's one of the beauties of the programs. The SBA Express program is a sub-program of the 7A program. Currently, until the end of the year, and it may be extended, that has a $1 million maximum, 50% guarantee because it's bank directed and bank approved. And one of the key uses of this program is a revolving line of credit, whereas the 7A is strictly term credit facilities. The Express program can be used for revolving lines of credit. The USDA B&I program, Business and Industry, is a very similar to the 7A program. It's a shared risk program. Maximum loan, gross loan amount is $25 million. So you can far exceed the SBA maximum. And these programs can be used on top of SBA lending limits. So if you have a borrower that may have used up all of their SBA eligibility and they're in a qualifying area that has to be in the city of 50,000 or less, they could use an USDA B&I program. Those guarantees range on a tiered basis from 60% all the way up to 80%. And extended term, commercial owner-occupied real estate can be as long maturity as 30 years, and 10 years for business acquisition, refinancing debt, equipment acquisition, and those kind of things. So good programs, and there's some of the highlights there. Next slide, please. So how do you, as community bankers, go about, first of all, identifying SBA or government guaranteed borrowers? What makes for some good government guaranteed transactions. And you have these kind of deals cross your desk every week. I'm confident of that. And the bottom bullet point, we're going to talk about that in a little more depth because I know you have some of these in your portfolio right now. So business acquisition financing, widely used, makes use of the SBA and the USDA loan programs. It's very difficult for a community banker to, first of all, deal with an intangible asset. Typically, these business transaction or business acquisition transactions have some component of goodwill. Well, that's an intangible asset, no collateral value. It has what the SBA calls enterprise value, and that can be very valuable. But you know, you're short of collateral, so how do you finance that transaction and provide acquisition capital? SBA or USDA guarantee. Business reorganizations. There's going to be some of that, and I think the pace is going to accelerate with certain businesses unfortunately failing or discontinuing operations and maybe selling off assets, reorganizing under some new ownership, maybe fresh capitalization. So those kind of opportunities exist in all of your local communities. Franchises, special purpose properties, hotels, motels, those kinds of transactions make for great government guaranteed lending opportunities. Permanent working capital. David talked about the stressed nature of our economy now. I think that's going to continue for a while, although vaccine, I guess, is around the corner here. So when that diminishes remains to be seen. But for a while, borrowers are in need of permanent working capital. Well, how can you as a community banker provide that to them? Well, one of the best methods is through that government guaranteed lending program. You know, mitigate the risk and provide permanent working capital on a long-term basis. Both SBA and USDA will allow you to go 10 years on an amortizing basis. Debt restructuring, the bottom bullet point, that we see this in our practice all the time. A couple things. Terming out existing lines of credit, conventional lines of credit. We see banks that, year after year, they have borrowers that have established a line of credit, and it really has become permanent. It's gone evergreen, and it doesn't revolve. And by the way, your friends, the regulators, will tap you on the shoulder every year and say, "What are you doing to manage that credit?" Well, one of the best opportunities is to take that evergreen, maturing line of credit, maybe include some permanent working capital, just a shot of cash, so you can absorb the fees and provide some permanent working capital. That guarantee covers that part of the funding. And put it on a 10-year term, amortizing. You force the borrower to make repayment. And you're doing about 3 different positive things there. Keeping the regulators happy, providing credit to your borrower, terming out that existing line of credit. You can also refinance existing debt, term debt, either same institution debt, that's your own institution. They have to meet a couple of tests there that the borrower can't be chronically delinquent, or other institution debt. I'm a firm believer that as we work our way through this pandemic, there's this whole tier of borrowers who are looking for a new relationship. And I'm not a big fintech fan. I'm a community bank advocate. So you at the community bank level, you're relationship bankers. You can make a lot of headway here by moving and restructuring other institution debt. So those kinds of opportunities are all over your communities for you. Next slide, please. So benefits to the lenders. Why would lenders want to get involved in this? You probably have all heard horror stories. Boy, SBA lending, it takes forever, it's complicated, it's expensive, I don't want to get involved because it's just a pain in the rear end. Well, the USDA and the SBA have currently revised their credit standards. Now, I said revised, not necessarily tighten them. They're just taking a little different look. For instance, if you have a continuing business that has been successful, cash flowing through 2019, 2020, basically the agencies are throwing that year out. They're saying that's such an anomaly that when you do your trend analysis, you kind of skip over 2020. So you go from your historical, which would include 2019, and then make the assumptions about the projected operations after the pandemic, passes and we get back to whatever it looks like normal. So those kinds of things require some more in-depth analytics. That's why one of the reasons we came into this joint venture with IntelliCredit, because they've got a great tool and it makes everybody's life easier here. Knowledge of these changes is critical. And if you don't have the time or the ability to keep up on all the policy notices and SOP changes and those kinds of things, that's what we can do for you. The guaranteed portion, again, from these government guaranteed loans is exempt from lending limits and reserve requirements. And again, one of the big benefits, not only to the borrower, but to the lender, extended term permanent financing on terms and conditions not available conventionally. So if we describe it this way, you have your conventional credit box. Now that may have changed with the pandemic going on, but you have that commercial credit box. What do you do with those marginal, I call them marginal declines, that are just outside your credit box? They have a story to tell. Maybe they've been stressed because of the pandemic, but they're still creditworthy borrowers and they're in need of financing. Well, you can turn them away. That's one option. Or you can try to work with them and look for that credit enhancement that's available through these government guarantees. So again, my message is embrace those marginal credits that lie just outside of your conventional credit box. And you may be in the process of kind of revising your credit box, but rather than turn a good customer away, this is a great time to solidify that relationship. So, next slide, please. Wait and see. Probably not a good strategy. As David mentioned earlier, because of the unique nature of the economy now, some of those credits are deteriorating, and the sooner that you can identify them and provide a strategy to them, that's going to solidify that relationship. So these borrowers need access to capital now. Borrowers may have never considered an SBA guarantee, and they've heard, it's too much work, or they don't want this, or they don't want that, all kinds of excuses. But maybe they got a PPP loan, and that saved their business, or was the lifeline that kept them in operation. So now maybe they're not so resistant to working with a government agency. If you can offer that to them, that's great. Your lending team needs to have some solutions ready to offer to these stressed borrowers. Again, you heard me say throughout the presentation, community bankers are relationship oriented. The big banks, not so much. I call it the 26-year-old loan officer syndrome. If you're with a big bank, you're going to end up with a 26-year-old loan officer who's on his way to his next job. So every 2 or 3 years, you got to change loan officers. Well, community bankers are long-term relationship borrowers, lenders, excuse me. The competition continues to increase. Borrowers have lots of options, including those darn credit unions who don't seem to want to pay taxes, but that's another conversation. So newly developed PPP customers, maybe they're new to the bank, maybe they've never had to borrow money before. So they are fresh fodder for SBA or USDA lending relationships. Next slide. A little bit about us. I haven't used up my 2 minutes of shameless promotion, so here we go. Again, we are an outsourced alternative to an in-house government guaranteed lending option. We handle all aspects of the lending process. I think we have a couple of our account executives on the phone or on the call right now. We're very involved, very accessible. We team up with your lending staff to analyze these credits and use the tools available through IntelliCredit. And we eliminate the need for your staff overhead. Again, there's that word. We've been serving bank. We've been at this since 1982, so we've been at it a good long time. We are endorsed by the ICBA as a preferred service provider, have been since 2006, about 440 clients. We also manage bank SBA, USDA portfolios, about $1.5 billion under management. And we've been involved with NAGL, National Association of Government Guaranteed Lenders, for decades, and a good organization. So that's the 2-minute shameless promotion. I think that's the end of my slide. I'm going to hand it off back to David.
Thank you, Arne. Certainly step number 8, which was I was advising would be appropriate for 2021, seeking alternative loan sources for organic loan growth. Arne's just given a wonderful description of how that can be affected at your banks. I would say for the other 7 steps, just in a recap of what we think IntelliCredit can help you with, and that is, can you navigate between your macro and transactional risk? Do you know the credit hotspots that may be emerging in your portfolio? Can you customize a look at your portfolio? As long as the data exists, the sky's the limit on the format and the story you can tell about your own portfolio. And does your loan review have some real-time connectivity, if you will, to your portfolio diagnostics? Again, telling your own story before the regulator does it for you. I do think all of this goes to the one issue that obviously during credit stress times can really become problematic between bank management and bank boards. And that is the continuous emergence of too many credit surprises. I've spent a lot of time with bank management and bank boards and that issue, and to the degree that issue does come up too often, I mean, we all know that credit surprises occur. Our goal is to mitigate or minimize those. It kind of conjures up lack of transparency or competence, and nobody wants to go there. So with that having been said, IntelliCredit is very focused on staying on top of your risk, knowing your credit hotspots, giving you a wide variety of aspects for your customized reporting, and it does have a rather innovative approach to handling loan review. Sean, I'll hand it back to you, sir.
Thank you, David. Thank you, Arne. Again, if you have any questions, you can submit them under the Q&A. I have a couple that will get started that have been submitted. And again, just if you have any, we'll take those now. So the first one, actually the first 2 go to Arne, and they were somewhat related. Will Holtmeyer Monson take on first-time SBA lenders?
Absolutely, and when we sign a new client on and establish our relationship, we do provide on-site staff training. So yes, if you've not ever been involved in government guaranteed lending and would like to, not only will we get you up and running, but we'll train your staff initially, and then we have recurring training through either on-site training or webinars and electronic methods. So yes, absolutely.
Okay, and the second one's kind of a follow-up to that one. Is there any minimum number of loans that a bank has to submit in the calendar year?
No. We have clients, our largest client does 100 transactions a year. Our smallest clients do 1 transaction every 2 or 3 years. So we don't have any minimums. We don't have any, requirements, any upfront fees, that kind of thing. If you've got one SBA loan that you need some help on, call us. We're happy to help you. And I guarantee if you do one, pretty soon you'll be looking for those opportunities, and you'll turn that one into about 5 or 6. But yes, we do not have minimums. Absolutely don't.
A question for David. David, does the IntelliCredit portal, is it available for internal and external loan reviews?
It is. It was designed intentionally to help banks that use either third-party loan reviews for their loan review or internal. And so, again, that was the whole basis for making it far more interactive and so-called real-time from a loan review perspective.
And then a second question, David, is for the portfolio analytics, where does IntelliCredit get the information?
It is largely through your core system, but also we have the ability, in addition to your core extract or core information, if you're using another spreadsheet or another database of any form or fashion, we will ingest that for explicitly for unique to your bank. We do the heavy lifting. We set up in effect a library that's unique to your idiosyncratic loan data, and we go from there.
And then one final question, it looks like for Arne. Arne, do you anticipate any additional SBA or PPP programs coming in 2021?
Yes, we're going to have, this is information hot off the press as of a couple of hours ago regarding a third round of PPP funding. To answer the first part of the question, we think that the SBA and the USDA programs are going to remain about the same. They've been well tested, and funding will be plentiful. So those will be much the same. As far as PPP, and this may solicit some additional questions, this is what the smart people in the industry are expecting in round 3, that there'll be between $300 and $350 billion allocated. We'll see how that finalizes. This program, the first 2 rounds were driven off of employment, and this will be off of top line revenue reduction. So earlier I talked about 2019, skip 2020 and go to 2021. Well, one of the qualifying matrix here is a reduction in top line revenues between 2019, 2020. So if you as a small business borrower have seen that reduction, that's one of the matrices that makes you qualify for the new round of PPP. The new program, we expect a maximum gross loan amount of $2 million. That's plenty because there were very few $2 million loans in the first 2 rounds. The average loan size was about $150,000 or $60,000. So, and a gross combined maximum of rounds 1, 2, and 3 of $10 million. So if your borrower has had a first 2 rounds PPP loan, maybe if they're still in the forgiveness portal process, they're still eligible for a new PPP loan, absolutely. So they can have 2 PPP loans. We expect some similar rules about the mix between payroll dollars and non-payroll dollars, and additional details to be announced. I would offer to all of you, we're kind of keeping our ear to the ground on this. So if you subscribe to our newsletter or go onto our website and give us a contact, we will get you on our email blasts that we're going to be initiating pretty regularly as these programs develop. But there is a third round coming. Timing, I think around the end of the year, maybe after the first of the year. We're hoping the first 2 rounds, if you were involved in it, it suffered from some lack of guidance. We hope that that's been mitigated. That remains to be seen. But I can tell you, we're going to be involved. We have made a portal available to all of our clients, either existing or new, and it's user-friendly, and it really takes the heartburn out of this whole PPP process. So if you're interested in something like that, reach out and contact me. I'm happy to get you pointed in the right direction. Long answer to a short question.
No, that's great. That's exciting. I know, I think it's certainly going to be timely for a lot of banks and their borrowers. So I think that's all the questions that we have. So on behalf of Arne and David, thank you all very much for joining us for today's webinar. I hope you found it helpful. We'll leave the screen up here. If you have any questions, you can certainly call us or email us, and we'd love to talk to you either about small business or SBA and USDA lending and or loan review and just some other portfolio analytics. So have a great day, and thanks again for joining us. Bye now.
Thank you, and happy holidays.
Thank you very, very much.